Hello, good morning, everyone. I see we still have some people logging on. I'll go ahead and get started just with some introductions, and then also going over just some housekeeping items. So first off, welcome everyone. Thank you for joining. We're here to talk about optimizing your corporate cash investments with monetary policy in Flux. Here today we have Jeff Probst, CFA and Portfolio Manager, and Jose Sevilla, Senior Portfolio Manager, both with longtime histories at SVB and working with our corporate cash management clients. I'm Nancy Fostre. I'll be your moderator today. Just to go over some housekeeping items. All lines have been placed on mute to prevent background noise. The chat function has been disabled, but please feel free to submit any questions through the Q&A function. And then we'll go ahead and send a link to the recording after the webinar. So with that, I guess we can go ahead and get started. And Jose, why don't I pass it to you to start out?
Thanks, Nancy. Well, appreciate everyone for joining today. I'm really excited to talk about this topic, as this has been a topic in everyone's minds, again, with the Fed and with the economy and where rates are headed. Where are we today? Well, I mean, current economy, for the most part, has been doing well. Economic growth has been solid. I mean, despite the sub 2% growth in Q1, and really going to credit the consumer. I mean, consumer has been resilient through all of this. I mean, even if you look at the broad market sectors, manufacturing sector, services sector, I mean, we've seen some trending of slowing. However, it remains in expansionary territory. Labor markets continue to be in solid footing. Unemployment rate near a 50-year low. I mean, we have weekly unemployment claims at pre-pandemic levels. We've had wage growth that's been solid, but still at that 4% year-over-year growth. However, given this morning's ECI, or Employment Cost Index, which is a broad measure of labor cost, did print above forecast. So we did see that pump in there. And we have an all-important jobs report that's coming in this Friday, where expectation is that print's going to come above 200K, where over the last 3 and 6 months, you can notice the average of 280 and 244,000 respectively. And so again, the economy continues to add jobs at a pretty decent clip over the last couple of months here. However, it has been an inflation story. I mean, over the past 12 months, core inflation, namely core PCE and core CPI, has trended downward. However, inflation reduction in 2024 has stalled, and that's really been the story. And so as we get into now, where the Fed is, as everyone knows, the Fed has hiked rates by a total of 525 basis points since March of last year, the fastest since 1980, right? And however, the full toll of these high interest rates have yet to be fully felt. And quite frankly, the pressures will probably continue to accumulate here. I mean, the Fed has been consistent with their message, which is to bring inflation back to their 2% target. And they've acknowledged that there's no urgency to essentially cut rates here, given the recent strength in the data. So what we saw from the last Fed meeting, we think is, this message is going to be across the Fed members that their messaging is going to continue to converge here, which is to possibly keep rates higher for longer, given the strength or the relative strength in the economy. And one of the things that we look at from a track record perspective is maybe looking at past cycles, because the Fed has been a source of stability. And so it remains to be seen how long the Fed funds rate will stay at these current levels. And again, we have to look at these, the past couple of cycles to really at least get some kind of reference points, right? In terms of anticipating when is going to be that easing cycle. And it's really difficult to tell right now, other than we got to look at the trends. I mean, given the strength in inflation and growth data, the markets have sharply lowered their expectations for cuts this year. But looking at the trend, I mean, if you look at inflation, trending downward since last year, while rates remain high, this creates an unnecessarily restrictive conditions, and the Fed officials are aware of this. And in terms of, expectations for rates and which way they're heading, markets now expect a slower pace of rate cuts, as you can see there, and a flattening of their expectations. Meanwhile, again, the Fed is still currently at the 75 basis points cuts for this year. But as you all know, we won't see their projections until, or revised projections until, the June summary of economic projections. But however, with tomorrow's Fed meeting, I mean, we could possibly see an adjustment to this view. So it'll be interesting to see, given a lot of this uncertainty and volatility in the market, where the risks are. And I'm going to point it over to my colleague Jeff here to discuss where the risks are tilting.
Thank you, Jose. Thank you, Jose. The future path of the Fed funds rate over the past 18 months has been a hotly debated topic, especially after the historic Fed funds increases in 2022, where there were, several 75 basis point rate hikes. Since then, the market has been very much so anticipating the Fed to change its course. We think back to last year, 2023, the Fed indicated 75 basis points more of Fed funds rate increases, which is fairly tame when compared to where 2022 ended up. At that time, coming into the year of 2023, the market was anticipating no rate hikes. So we look at kind of the risks in the market and where, as investors, we may want to position ourselves. We need to look at what the market is showing and what the Fed is saying. And definitely the market has been one of much more optimism that the Fed's policy would become more accommodative. And it's actually become a bit more restrictive as Jose has shown. As inflation has reduced, the Fed funds rate has held at a rather high level. So coming into 2023, we have the bright blue line, which is the Fed funds rate expectation for the end of 2023, which indicated 3 more rate hikes. And then the darker gray line is where the market feels the Fed funds rate would end the year. So we see about a 75 basis points difference of opinion. So as investors, that gets boiled into the yield curve. So we must make positioning decisions at that time. So the market is thinking that there would not be hikes. The Fed is saying there will be. In the first half of 2023, it was a fairly, volatile 6 months of that year, and the Fed still continued to raise rates 75 basis points. As we move into May of 2023, the same thing happened. The Fed had already completed their third 25 basis point rate increase, yet the market was expecting the Fed to actually cut those hikes away by the end of the year. So as we sit there as investors, the economy was still doing well. The Fed continued to say we're going to stay higher for longer, yet the market is saying you're going to cut away. How do we position within that, that paradigm? And that's, I think we'll see a lot on the next slide as we move forward. No, not yet, Jose. As we move forward through 2023, the market came back to the Fed's expectations of that, the Fed funds rate was going to be higher for longer. As we now look to the right side of where does the market see us today? And why are we kind of on this call here today as well? The Fed funds rate expectations for 2024, the Fed, which is the bright blue line, expects us to end at 4.6%, which would indicate 75 basis points of rate cuts. This may change a little bit. This was last updated in mid-March, but a lot has changed within that past month and a half. The market has seen even bigger changes. Coming into 2024, the market was expecting the Fed funds rate to kind of, end the year at about 375, which would indicate over 6 rate cuts in 2024. To us, that felt a little bit, extended, a little bit overly optimistic. And then as we came into 2024, a series of strong employment reports, as well as sticky inflation readings, made the market reassess their views on cuts. As we sit today, the market's only anticipating about a little bit over 125 basis point rate cut this year. And it's basically been pushed out to the end of the year, December being that kind of that time of being a cut. So things have definitely changed in a couple months, but we still think that there is risk out there as we look to the next slide. As we look at the 2-year Treasury and where we feel there's potential risk, to the downside. We did a very similar webinar back in early October of 2023, highlighted by the blue box. What we felt was the 2-year Treasury has made a nice run up. It's over 5%. Yes, yields could still move higher, but how much higher could they go? But could they go lower? And that was our view, is there is definitely situations and possibilities of the 2-year Treasury moving significantly lower. We thought of, moderating inflation, geopolitical issues, numerous different slowing growth, the consumer rolling over, due to higher borrowing costs, etc. We're not trying to pick tops and bottoms in terms of yields, but we definitely felt that there was, a skew to the downside of yields moving lower. And after a couple inflation prints that came in below expectations of the market quickly started to price in those 6 or so Fed funds rate cuts. What did that do? That pushed the 2-year Treasury down about 90 basis points from the peak to the bottom that we saw in that January, December of 23 type time period. So that risk is out there, and we feel that's kind of a similar situation that we're in now. The market has repriced in, given some sticky inflation readings, but we feel it would only take a couple, data prints that might tilt the market's opinion, and then we would start to see rate cuts come running right back into the market. The one consistent factor throughout the past 18 months has been the Fed. They've been very, very consistent with their message of 2% inflation. And it takes a lot for them to change their opinion. So while an inflation print might come in lower than expectations, in the coming months, the Fed will likely discount that and say we want to see significantly more data. But what we have to invest in and the way we need to position portfolios is subject to market conditions. So we view this is probably a decent time to take on some duration when it's possible within a conservative strategy. Just given that we do think that there are some downside risks. Looking at the next slide, we dictate what could cause yields to go lower. Moderating inflation data. We saw that 6 months ago. We had a string of inflation data that pushed yields significantly lower. We have since recovered from that. Geopolitical risks, I think that we are all very well aware of heightened issues around the world, and those could always cause things to happen. We could see flight to quality, people running to treasuries in a situation of panic, but there's also inflationary pressures that could come on alongside some of those risks as well. Slowing global growth. The U.S. has been doing well. Overseas, in different economies have been slowing as well. Consumer stresses, always top of mind as prices get higher. Consumers may become a bit more stressed. And then what could push yields even higher? I mean, we're not saying this is the top. The labor market could continue. Jose noted expectations for a fairly strong report this coming Friday. We have seen that resurgence in inflation. What if it keeps going? We saw the employment cost index today continues to move higher above expectations. We've seen decent corporate earnings. The economy's humming along. And then also, there's a lot of debt that needs to be issued as we continue to run deficits. Interest cost is continuing to increase as the U.S. Treasury market is being repriced into much higher rates. And then the Fed's balance sheet is another thing to consider, but lesser so. So we just think that it's on a risk-adjusted basis, this could be a good time to move some money into some duration if possible. And then looking at what some of the Fed members are saying about the most recent data, I was just going to call out the top three, as Chair Powell is, one of the main speakers that we pay attention to. Over the past 30 days, really since the last Fed meeting, we did receive that third inflation CPI report that came in higher than expectations, or actually a little bit stickier than expectations. And many of the Fed members, I would say the consensus changed to being, yeah, basically we don't have any urgency to cut rates. Looking at Lori Logan, concerned that the stance of monetary policy may not be as restrictive as some may think, basically. So maybe we're not as restrictive, and that kind of hints at, do we need a hike in the near future? Michelle Bowman, I think it's restrictive, and I think time will tell if we're sufficiently restrictive. Again, kind of hinting that there may be some upward pressure there. And then Chair Powell, who was, kind of the last one to speak before they closed off their media speaking engagements, talked about the strength and the lack of progress in the inflation, strength in the labor market and the lack of progress on inflation. And, basically thinks that they're appropriate. So took away kind of some of that urgency to cut rates here in the near future. And then market has definitely, changed their view as they have pushed away cuts out towards the end of the year. So I'll toss it back to Jose to go over some positioning and other ideas.
Thanks, Jeff. So in terms of where we are, I mean, we're the highest that we've been in rates since 2000, 2007, 2008. And as Jeff had mentioned, I mean, we could be one or two economic data prints away from markets pivoting again to as we saw earlier in the year, right, or even late last year. And so, the main takeaway here is that when the Fed acts, cash is going to act accordingly, or money funds will act accordingly. As you can see here, the correlation between Fed funds and government money market funds. And term rates have cheapened recently, given the strength in inflation, right? I mean, in looking at the trends here from past quarters, I mean, look at where term rates starting with 1-year treasuries all the way out to 3 years and to where they are today, relative to where money funds were still in that, call it 520 context. I mean, and this is beneficial here in terms of the cost of adding duration here, because if you think about it, this is beneficial for those who are looking to preserve cash and preserve the income potential for a longer period. And as we all know, investment income on corporate cash portfolios can be additive and can be beneficial, for example, as cost offsets, for example, for a lot of our companies that we manage for. And so with that, I mean, looking at the track record of adding duration, I mean, there's nothing revolutionary here. We all know that duration will outperform when rates move lower, but look at the magnitude differences in return, right, over the past 3 easing cycles, right? And yes, there's a lot of uncertainty surrounding where interest rates are headed. I mean, we could still see, to Jeff's point, that given some relative strength in the data, rates could still move slightly higher, right? But in terms of raising rates, I mean, it would have to take a reacceleration of inflation for Fed to raise rates, as an example. And as was noted earlier, the risk reward spectrum are currently really tilted towards in favor of rates moving lower, as we alluded to. And there's an opportunity here to take advantage of this high rate environment. I mean, rates that we haven't seen since 07, 08. So duration can be your friend, as it titled here. And really to mitigate that investment or reinvestment risk, and also lock in that certainty of income. I mean, from a budgeting perspective, this will help from an income forecasting or even reducing uncertainty around cash budgeting. So in terms of positioning, or how do we do this? I mean, for investors, the focus still hasn't changed. And let me reiterate this. I mean, investment strategies remain aligned. Our investment strategies still remain aligned with the objectives of capital preservation and liquidity. And the focus here is to structure investment portfolios along the curve that fits within a company's budget plan or cash runway. So with that, I'm going to point it back to Nancy in terms of some of the things that we do here at SVB Asset Management for our clients.
Great, thanks, Jose. So we have been talking primarily today about Fed rate movements and using duration in portfolios. But the emphasis here is a tailored approach for each client. So I did want to mention that we have a wide range of investment offerings that fit our clients' specific needs, whether they're a startup with limited fundraising or a large company with billions of dollars on their balance sheet, and everything in between. Our solutions are custom tailored to each client's needs, their unique spending plans and investment profile, and include different approaches, including the ability to have all funds 100% government backed. We're happy to help set up infrastructure that is helping establish and implement your treasury policies and investment strategies, or just act as a sounding board to review any existing strategies and policies you may already have in place. Some of you have submitted questions, and there are a few of these I just wanted to field because they relate to a new set of best practices in corporate cash management that boards, investors, and senior management are now asking for. Many companies are now setting up their treasury and cash policies so that they're able to achieve sources of redundancy in several ways. One, in financial partners, two, in locations of where cash is held, and three, redundancy in wire capabilities and wire platforms. We're also now getting a lot of requests to set up segregated custodial accounts. And so I just wanted to put forth that I'd be happy to follow up with any of you to talk through what these things mean and how to achieve this new normal of best practices. That concludes our content portion for today. I wanted to thank you all for attending. If we can just forward to the next slide. If you have any other questions or information requests, you can direct them to me or direct them to Renuka Kumar. We were happy to help. Again, thank you for attending.